Thank you to our last panel. That was a really fantastic conversation. So as Clive said, I'm joined now by Alice Carr, who is Executive Director of Public Policy at the Glasgow Financial Alliance for Net Zero, or Gfans as we will call it from now on. So Alice, we've obviously had a lot today from central banks in terms of all the various activities that they're implementing into their different activities and how they're looking at climate. Your background before Gfans has obviously very extensively been in central banks. So how would you assess progress over the last few decades or the last decade, and where do you think central banks should focus now in the run-up to 2030?
Thanks very much, and thanks very much for having me. It's great to be here. And I know that I'm the only thing that stands between everyone and drinks, so sorry about that. Nonetheless, so I have a couple of decades background in central banking, mainly in financial stability and crisis management, and then increasingly on the international policy side, and now with a very much a climate focus. And so my reflections today are kind of, drawing on my personal experience over that period. I mean, we've obviously come a huge way in the last kind of decade. As early as 2006, we had the seminal Nick Stern report, which made it quite clear that the economic effects of climate change were going to be significant. And I think after that, we've sort of seen a gentle nudging up of ambition on this topic. And in the mid 2010s, I think it was fairly transformative. And I'm not saying this just because he's my boss. That Mark Carney spoke about the tragedy of the horizon and the kind of challenge that we were facing that was at that time most evident for the insurance sector. But that was around the time that we began to use this kind of common terminology around physical risk, transition risk. These are the kind of measures of risk that we're still looking at today. And then we, of course, saw this building commitment from central banks and regulators with the founding of the NGFS, work on the TCFD, which was, recognition that climate risk is financial risk, and that it needed to be measured and disclosed, and so that investors could take it into account. And you'll have heard today that central banks are active, and the NGFS started with just a few members, and is well north of 100 members these days. But many central banks are working across their full operations, so they're looking at the risks to the banking system, in the insurance sector. They're looking at macro-prudential risks. They are thinking about their own market operations and how to take account of climate risk there. They also, increasingly thinking about the economic effects of climate change. Or I think that's an area for further work, and has tended to lag the more financial side of things. And so we've got to the position, I think, where central banks are cognizant that this is a building risk, that it's relevant to macroeconomic outcomes, it's relevant to financial stability outcomes, and as such, it's well within their mandates to be thinking about these challenges. But the question then is, what should one do next? And I guess the thing for me that's important is we don't have very long left to 2030, and we know that the emissions reductions we need to achieve by then are really significant. We saw with the IPCC report earlier this week that we're not on track. So we faced, either a scenario where we fail to do what's needed, and the implications are quite severe, or we have to quite quickly step up our policy efforts, and that's all kinds of policy, government policy. Almost every government department has a role to play. Central banks, regulators, private sector, everybody. And we really work together to try and do what we need to do. And so I think for me, the most useful area of focus in the next phase would be exactly that, kind of what is it we're going to do about the risk that we've started to identify. And I guess with some perspective, having had a kind of year or so out of central banking, I think we'd be well served in pivoting to risk mitigation, even though we haven't perfectly sized the risks, and there's much more work to do on scenario analysis, which is a super useful tool. Nonetheless, if we wait until we have perfection there in terms of risk identification, it's going to be too late to mitigate the risks. So I would recommend that we kind of collectively pivot to the mitigation piece now. Thanks.
Yeah, one of the things that we were talking about earlier on when we were talking about scenario analysis tools is the difficulty of implementing macro considerations and how kind of that is not necessarily being factored in properly into stress testing tools. Bit of a challenging question maybe, but moving forward now, how specifically can central banks enact that, and what can we do over the next kind of 7 years? What can central banks do in the next 7 years to work and to integrate that into what they're doing?
So here I would suggest, actually, just as we did with TCFD, I think the private sector has a useful role to play here, because I think, to an extent that isn't always apparent, I think the private sector has kind of moved to thinking quite hard about risk mitigation. And at least in the case of Gfans member firms, we have, we're sort of founded under the UK COP presidency. And of course, therefore, we have a really good representation of UK firms in the 7 sectoral alliances that make up the kind of Gfans family. All of those financial institutions, of which there are now more than 550, and they account for more than around 40% of global private finance by assets, have actually made quite strong commitments in that they've committed to supporting the transition to net zero across all scopes for their activities by 2050, in line with 1.5 science-based pathways with low or no overshoot. And as a result, they're kind of moving through a cycle of setting targets to deliver on those commitments, and then undertaking transition planning. And the thing about transition planning is, it's kind of difficult and imperfect, and I'm not going to pretend that we're anywhere close to anyone doing it well. But the thing is that once you start to do transition planning, it kind of makes you engage with what are the sectoral pathways for the sectors that I'm financing, how far is public policy doing what I need it to do, how far are corporates doing what I need them to do, what are the barriers, how are we going to get them addressed in a timely way, et cetera, and it's actually a really important discipline for thinking about, more specifically about how we get to 2030. And so I think that process is generating a lot of information increasingly about, what steps will be taken in the, and what changes will be wrought across the economy and the financial system in the period up to 2030 if we are going to get anywhere close to the kind of emissions reductions needed. And so you can kind of get a picture of, what needs to happen to the energy system, what kind of transformations do we need to see in transport, in cement, in steel, in all of these different economic sectors. From that, you can start to look at, what's going to happen across all of the economic variables that you would normally worry about as a central bank. But I think it also is really important to think about transition because these changes are going to take place over the balance sheets of financial institutions. And so I think it's really important to understand what benefits this transition is bringing in terms of risk mitigation, because it is fundamentally the only way to mitigate the risks in any sort of conclusive way. And secondly, you need to understand these changes because they're going to become greater and greater through time, unless we completely fail in our objectives, in which case you also need to know that. So I would,
Let's hope we don't completely fail. No, so I think you started to touch upon this already a little bit, but obviously we just had a session on impact investment and the scaling up or kind of the green market. So where is the private sector with its own efforts in kind of reaching net zero? You touched upon the fact that, transition plans are being made, pledges are being made. But what does this mean in practice, and how is Gfans in particular kind of supporting those efforts and that transition?
So, in some ways, we've come a long way in that we're still less than 2 years old as an organization. And so we've got, I guess in the first year we had a period of kind of building out membership, encouraging financial institutions to make these commitments. And, just to stress, like across the alliances, there are all types of financial institutions. So there are banks, insurers, asset owners, asset managers, but also lots of important kind of infrastructure providers, data firms, rating agencies, or, sort of anything you can think of that matters in the financial system is represented in some way. And, firms from 50 countries, so this is clearly something that has kind of global resonance. And, it is quite early days. These firms have made this commitment. Then they, under the commitments, so the nature of the criteria that they individually signed up to were determined through the UN non-state actor process. And so those require them to kind of set targets after a certain period of time, to have those targets assessed by the alliances that are responsible for kind of monitoring progress. And then they have to kind of deliver on those, start delivering on the targets through transition planning. So what, Gfans exists to kind of help coordinate across the sectoral alliances and help build frameworks and tools that the private sector needs. And I guess critical things for us last year, which I'll flag, were, I think, working through our members, we spent a year thinking about what is transition finance. Because I think, over the last decade or so, we've spent a lot of time on green finance, which is kind of fine, and, in the end, everything needs to be green. But right now, probably less than 10% of assets are very green. And so what we need to do is transition the rest of the system in an orderly way. And so we've been thinking about, the types of financing that financial institutions need to engage with across a broader spectrum. So not just, the climate solutions, which is kind of our reference for green, but also to think harder about which companies are already on a transition pathway, i.e. they're aligned with net zero, even if they're not green today, but they're on a pathway. Which companies are converging on a pathway, so they're kind of going in the right direction, but there's progress to make. But we're also encouraging them to think about how to deal with what will in the end be stranded assets. So, and I guess a particular focus for us has been coal, because in, particularly in emerging markets, there's very high coal dependency in, Asia Pacific, etc. We need an orderly way to manage those assets out of the system. So we're trying to work with firms on what kind of a financing approach for managed phase out looks like that has the right guide rails, but that allows emerging markets to access the financing that they need to perform a transition. And then the other major thing we delivered last year is a globally consistent framework for transition planning, which is intended for use by financial institutions, but we also use the opportunity to set out what those firms would like to see from the corporates that they finance. And this is just to kind of speed up the process of transition planning, I guess make sure that it's as consistent, comprehensive, and credible as it can be. And for us this year it should be a year of transition planning, so we're strongly encouraging financial institutions to start the process of transition planning if they haven't done it already, and through time to disclose the results of that.
Yeah, next, and obviously we had the transition task force planning, which is being developed at the moment, and just as a heads up, SPI will be hopefully doing things with them in the future, so do keep an eye out for that. It's something that we're definitely exploring and looking to support as well. And so again, I think you probably already touched upon this a little bit, but just to go a little bit deeper into kind of what private finance needs from government and from policymakers to kind of enable the transition, and looking at the real economy as well, what the real economy needs to do this, and the kind of wider financial sector.
Yeah, great. So So we had quite a bit of discussion about this last year, because in some ways the private sector have made quite ambitious commitments, but we're pretty clear that global private finance can't get the world to net zero on its own. So we tried to be a bit crisper about what it is that we need from governments, and so it's clear that the financial sector takes its steer from government level commitments to net zero. I mean, that's why so many firms have made their own net zero commitments, because this has been a feature of the global climate architecture. And every time governments are clearer and crisper themselves about how they're going to deliver on those commitments, and they follow through with policy, it has a really kind of catalytic effect on the private sector. And so there's huge demand for governments to be clear on how they're going to deliver on net zero, to make the policy that's seen as necessary to unblock progress in the private sector. And that's particularly so against the backdrop of an energy crisis, where inevitably we all had to take short-term measures to manage those stresses. But it just increases the need to then have clarity about how we're all going to get back on track, in the run-up to 2030 and 2050. We also looked at, as already mentioned, the fact that we need global frameworks for transition finance. We don't have those currently, just to be frank. We need firms that understand which kinds of transition finance are recognized as needed, and for them to feel comfortable providing that kind of finance. And the most extreme example is dealing with kind of the managed phase-out challenge, where, of course, most global firms, and indeed, the public sector financing bodies, are pulling back from things like financing coal and so on, new coal, etc., quite understandably. But the challenge is that if we overdo it, then countries that are trying to transition away from those kind of energy systems just won't have the financing they need to do it. So we desperately need those kind of frameworks to bring greater clarity and confidence to get the finance moving. We also, it's quite, in some ways, it's going to be quite a slow process if we rely on financial institutions to speak to all the corporates that they finance, ask them for transition plans, rely on them delivering them voluntarily and to a high standard. And that's the way in which we try to get to speed things up to get to net zero. So, there's quite a lot of pent-up demand in the financial sector for more transition planning by corporates. And so that's why, one reason why the UK efforts to implement transition planning domestically are seen as quite positive amongst the financial sector here, because, it just speeds things up, and gives you the information as an investor or a financer that you need to consider transition. And I know we're going to come on and talk about it, but there's a huge swathe of things we also need to do to unblock cross-border capital flows for transition.
Yeah. You mentioned the energy crisis, and today we talked a little bit about carbon pricing. We're talking about impact investment, moving capital flows. Obviously, a huge part of that is putting more money into renewable energy and kind of shifting the current energy flows that we're seeing. So how should financial institutions approach financing the energy transition, and what specific challenges are faced, and how can the financial sector overcome these challenges?
Yeah, so we commissioned some work last year from BNEF, or Bloomberg New Energy Finance, to look at taking the kind of the most credible scenarios that everyone in the system relies on, to look at what sorts of investment flows do we need to see, and that indicates that for every dollar or pound of investment into current energy systems, we need to get up to 4 in the energy systems of the future. And there's a couple of things about that. So firstly, it's not 0 in current energy systems, because we do need to transition, and we need to do it in an orderly way. Otherwise, there's a risk we lose support and we lose further time on the transition. But we clearly need to ramp up financing into renewables, etc. I guess from the work, we've been doing, it has come to a point in the last couple of years that renewables are pretty price competitive in lots of parts of the world. So there's a nice map, I think an IEA one, that shows like for much of the world, renewables are now cheaper than the alternatives. But that doesn't mean it's straightforward to transition. And so I would say that, whatever country is trying to perform the transition, you go through a sort of similar pathway, which is that many of, your current policy setup, et cetera, is designed around the energy systems you've had for decades. And so it takes a bit of time to adjust that and incentivize the new energy supplies that you need. And you need public policy for that. The UK had some success with the contracts for difference, which really helped us ramp up renewables. But you need to plan for your energy mix, based on country-specific factors. You need to have the right grid infrastructure. You need to have the right storage, et cetera, because renewables that have different profiles to some of the existing energy supplies. So there's lots of work to do. The economics of it are pretty encouraging, but it takes policy and policy signals, and then I think you generally find that the finance goes where it needs to go. But
right, I'd like to maybe open it up to the floor. I don't know if we have any questions from the audience. Yep, just at the back there.
Hi, I'm Adair Bentheim from Bearings. I know it was cited in a question earlier from one of the other attendees, but wondering how the increased politicization of ESG, I suppose climate change has always been a pretty politicized discussion, but how do recent moves in the US affect the work that you're doing and impact all of the different members of those different alliances that you lead? Thank you.
Yes, I think, I think it's, if you look at countries that have made real progress on transition, it tends to be helpful to have like a degree of political consensus. And so, it is challenging if there's a lot of disagreement on what needs to happen. I mean, that said, I think we've reached a point where, the science of this is so clear, and, I was looking at the stats for the IPCC effort that was put out this week, and the number of scientists they rely on, the number of kind of citations they have, etc. We've got this process running now where we have this exhaustive, regular report that tells us what the science is, what needs to happen in terms of energy and investment, all of those things. So I don't think in general, people are in doubt about what needs to happen. And so, of course, it's difficult if there's political pressures. But I think, on the whole, the financial sector is kind of minded to be on the right side of transition. So, that's both about kind of seizing the opportunities that transition presents and also mitigating the downside risks. And so I don't want to pretend that, all of the net zero commitments made are, in some way altruistic or whatever. I think, most of them are grounded in cold hard facts, to be honest, and assessments of the, the opportunities and the risks.
Thank you. And we have another question over here, Dora.
Thank you, Emma. Thank you, Alice, for your very insightful thoughts. I know that it's probably outside your current framework or current mandate, but I would like your views based on your experience on adaptation financing. I mean, we talk a lot about the transition and everything, and that's part of what you do at the Alliance. But based on your experience now, how do you envisage and how do you see adaptation financing moving on in the next decades? Because we know that we're going to have to focus on that as well at some point. The impact is inevitable. Whatever we do, there's going to be certain effects that we would have to be adapting for.
Yeah.
Thank you.
So it is, the kind of, as you noted, the kind of mandate for Gfans is quite grounded in net zero transition. But we are thinking quite hard about, and I think this is particularly relevant in the adaptation case. We know that the countries on the front line of climate change are often those that can least afford to deal with it. So we're thinking really hard in general about how to get capital to where it needs to go. And it is quite a difficult challenge on a number of fronts. So, you know, notwithstanding climate of any kind, whether it's mitigation, adaptation, or whatever, you know, capital flows to emerging markets and developing economies took a big whack with COVID and reached quite low levels in the last couple of years. And so kind of jump-starting those so that we get finance to flow for all of the climate needs that there are is really important. I think we take our lead from the kinds of analysis done by, you know, for example, Stern, Songway, et cetera, who have identified total climate financing needs of like 2.4 trillion a year for EMDCs, with kind of some of that being financeable locally, but, you know, at least $1 trillion of it needing to come from external sources. And that's, I guess, where we can partly play a role. And so we are working really hard to think about what is it that blocks capital flows, how can we unlock those through the lens of climate, and working at kind of all steps in the process in terms of, you know, being clear on the policy objectives, being clear on the policy frameworks needed to attract the finance, working, you know, how to jumpstart project development, how to kind of find new financing approaches that de-risk investments where that's appropriate and needed to get the finance to flow in. And my sense is that if we could unblock those capital flows, I'm not sure that there's always such a big distinction for some of the investments as we sometimes have on the policy side between transition and adaptation financing. You know, some of these investments might cover off both in a way. So I think if we could unblock the barriers and just get more capital flowing by improving each part of the kind of chain of investment, it will well serve both mitigation and adaptation purposes.
We have another question over here, but I had another question myself. I think you just partially answered it, to be honest. But and it's something we're exploring in a lot more detail tomorrow in terms of transition finance, capital market flows, especially in emerging economies. But my next question was how can we ensure transition flows are global? So looking at kind of emerging markets and developing economies, ensuring that they're well positioned to attract transition finance and external investment as well, to deliver their own commitments and to ensure that they're in the best position to raise that capital and to develop their own kind of sustainable markets too.
Yeah, so I mean, it's really important. I think, you know, when we looked last year to see what the scale of capital flows had been in recent years, and this was, you know, with a particular focus on kind of energy transition, we were a bit shocked about how thin, you know, if you strip out, strip out China and India, like the flows are very small. And so I guess our sense is that this is going to require new ways of working and new frameworks and new instruments as we go forward. So new ways of working, we've quite strongly advocated for more collaborative work across public and private finance. We know that the scale of public finance is just not going to be enough to fill this financing gap. You know, the kind of financing needs are many multiples. So we need to unblock private finance. At the same time, there are good reasons why private finance doesn't always make it to where it needs to go. And so in some ways, supply and demand for this finance are not really meeting.
Why is that, out of interest?
Well, I think if you're a global firm thinking about where to invest, you know, there are a bunch of factors that could deter you from financing transition in an EMDC. You know, it might be that you just don't have sufficient local presence. It might be that you don't understand well the policy environment. It might just, you know, it's kind of a well-trodden path that there are actually, you know, the effort we need to go to internationally to ramp up the number of projects is quite significant, so it can be quite hard. There are funds out there that have been raised to invest precisely in EMTC transition, and they, you know, and then they face the challenge that I can't find projects to put the money into. But it's also, there are other factors like scale of the project. So, really big global firms don't, always go after the smaller projects. So there's, we need to think about how we pool projects and standardize projects and so on. There are lots of kind of other wider risks, macro risks and so on that can be a deterrent. And, fundamentally, if you're a financial institution, you have a bunch of factors you have to think about when you're making an investment. And so when you take these together, it can be enough to kind of deter that flow of finance. But at the same time, we have an optimism around the fact that so many firms have made a net zero commitment and need transition assets globally, basically, to invest in. And so we feel that there's a way through this where public and private collaborate, particularly in country-specific initiatives, where a government is showing leadership by setting a more ambitious transition pathway, is mobilizing its domestic resources to turn that into kind of planning and energy resource planning and projects and so on and so forth. That we really need to find new ways of bringing together public and private finance that de-risk for some of the risks that the private sector is just not going to bear, but at the same time don't crowd the private sector out by just financing the whole project with public money. And it does require new ways of working. It's not, I don't think historically it's how we've done financing, this type of financing, but there are an encouraging number of sort of such funds or such financing structures emerging. And I guess one of our, alongside transition planning, our second area of focus for this year is ramping up this kind of financing cross-border. The other thing I'd just say is, and you mentioned it before, is, of course, a lot of financing needs to be local. So there are questions around how can as mentioned, if we had better global frameworks for transition finance, that benefits everybody. And so if you're an emerging market trying to attract capital, it's really helpful if it's recognized globally that your transition finance needs are not all kind of green assets. Some of them are about phasing out other assets. And yeah.
No, definitely. Marcus, you had a question.
Yeah, thanks. So I think you're making some excellent points about emerging markets, developing economies, that there might be a credit squeeze there. How about advanced economies? Do you think? I mean, just coming from Denmark, pension funds are obsessed with green projects. I mean, it would be very difficult to convince me that a profitable green company in Denmark would not be able to get funding somehow.
Yeah.
But that's an advanced economy.
Yeah. No, I mean, as I mentioned, I think like the economics of some of the things we need in the new world, particularly the renewable system, are quite compelling. And so we have to, I think it was a few weeks ago that the IEA really revised up their estimates of the share that renewables would account for in financing and over the next couple of years, because it's just become kind of in some countries a no-brainer to put your kind of energy financing into that type of activity. And I do think that we're seeing signs of progress. So I mentioned that we're looking for a kind of 1-to-4 ratio, and some research we commissioned recently that came out a few weeks ago shows that it's about parity in advanced economies, but it was lower than that before, and the targets that big global firms have are much higher still. So I don't want to overstate the progress, but it feels like there's a sort of an upward trajectory, and I do think that policy making in advanced economies is sort of accelerating a bit on that front. At least we've seen a kind of wave of incentives created for kind of investments in new technologies and so on and so forth that are needed for climate solutions. So I think you're right that I think it's possible, though, that in advanced economies, you just need to keep the momentum up, because you can have a run of success and then you hit some kind of constraint, and then it needs policy to address that constraint, and then
Do we have any other audience questions? Yeah. Thank you.
Thank you, Angela Vieiro from AG Strategy. It looks like the last couple of years there has been a ping-pong. It looks like a ping-pong between you guys and the governments, right? And obviously, and you are right, is the work of the governments to take leadership and to bring sectorial policy for each of the different industries that the financial system works. But lacking that, and lacking a Gfans, we don't have a global public sector alliance, but we have a Gfans. And you have, across the institutions, just take the top 20, 30, for the 10 sectors of high GSG, huge expertise about those industries. Actually, they have the direct access to the top corporates and the top clients that they need, that industry sector. Why not to, or to what extent has been considered having an started for 10? And started for 10 towards the public sector, so you force the conversation. Put proposals of policies, obviously with different options, with pros and cons, so that we do the consultation the other way around. Normally it's public sector proposal and consultation, where we start with the consultation. But because it's in your own interest, in the interest of everyone, as well in the industries, and then even helps as well the public sector, because let's not consider that they have a lot of limitations themselves, knowledge even, right, on all these particularities, because the nitty-gritty is what matters. So has been that possibility that is in the mind?
So I do credit the UN with recognizing that, as well as having the kind of governmental process of net zero commitment setting and policy, etc., that it was important to energize the private sector. And I think that, that was a really important move, because I think there are times quite genuinely where the public sector is moving and making bold policy choices and so on and so forth. And then that incentivizes the private sector to act. But I also think that, it works. There are times when it's working the other way around. And so having energized the private sector, there are times where the private sector is acting, making it easier for governments to act, because it's kind of already starting to move its financing to where it needs to go. And so it's a mutually reinforcing and disciplining mechanism. And I think that that was hugely important, and personally I feel a lot more optimistic about making at least a good chunk of the progress we need to by 2030, having all of these parties involved. I think for our part we try to surface the areas of policy that would most unlock progress in the private financial sector as frequently as we can. So we had a call to action ahead of COP26, which set out, we were quite a young organization at that time, so it was kind of our initial take on that. And then since then, we've refreshed it, and we put something out last year before COP that sort of dug down, based on our more recent experience ourselves of trying to move on net zero transition, what more specifically we need. But you're completely right that we have to keep going there, and as our understanding of what's needed gets more sophisticated, we should feed that back to government. And I think we've all realized that if you're trying to get different sectors to move, whether it's energy or cement or steel or aviation, when you drill down into what's obstructing progress, it's some kind of complicated, well, it's not that complicated actually, it's some kind of combination of policy, technology and financing. And so you kind of need these cross-sectoral, public-private sector efforts to just pull out what these barriers are and problem solve for them. And we have to do it more collaboratively and quicker than we would normally do with policy making, I think.
How can we encourage better collaboration between the two sides? Difficult question.
It's a good question. I mean, rightly or wrongly, I think we've been stressing that from our experience in the private financial sector of starting the process of transition planning, we realize what a valuable tool it is. And so I think, going forwards, a lot of our focus is on trying to do more of that transition planning, including by sectors, and pulling in relevant parties And there are really good examples of where that's worked. So, some of the progress that's been made in India, for example, on electrifying transportation has involved pulling, government, state-level government, city-level government, bus providers, bus operators, the public, the financial sector, etc. And we're here, we want to get to here, what are we going to do? And sort of intensive collaborative policy making, I think, is needed to bring about the change at the pace needed.
We are definitely out of time. So any final takeaways or remarks? And then I'll pass on to Clive to close.
No, I mean, just to bring it back to the broader question of central banks and regulators and so on and so forth, and talking about the kind of collaborative efforts. It's sometimes suggested that there's lots of pressure on central banks to act well beyond their mandates, and and that would be quite a sort of negative thing. I just wanted to highlight that I don't think that's the space we're in. We think that we need more from government policy. Almost every government department has a role to play, as mentioned. We need more from the corporate sector. We need more from the financial sector. And I think it's just that, all parties have to lean into this problem a bit and think about what tools do they have available, what role can they play in this. And I think it's clear that for central banks and regulators, that the change we're talking about here across the economy is pretty significant. And so you really need to lean into understanding that and thinking about how it's going to affect how you deliver on your policy mandates. But I think it's also important to think about your role in both facilitating that process and also not inadvertently slowing it down. And so, I think it's important to be thinking about what kind of shifts of activity we're going to see. How does that impact me as a policy maker? Do I need to do anything about that, or I don't? And so I don't think it's about asking people to do something that is outside of mandate at all. I think it's just the scale of this change is so significant that we all need to kind of apply our brains to how it's going to play out.
Yeah, I think that's a lovely place and way to finish. Thank you ever so much, everyone, for listening. I'm just going to pass on to my colleague Clive, who will be closing the day. And thank you so much, Alice. Really appreciate you joining us today.
Alice, turned out I'm the final block between everybody in the bar. But as my colleagues will tell you, I can be a good enabler on that front as well. I'll keep this short and sweet. Alice, I thought that was a wonderful way to finish a brilliant day. That was such an eloquent explanation of the challenges that we face, particularly on the role of public and private sector working together, which is actually the raison d'etre of ONFIF. That's why we're here, to encourage exactly that. A couple of hundred yards up the road today from this wonderful venue in Westminster, there's been a former UK Prime Minister trying to sustain his political career by arguing that the parties he attended weren't actually parties at all. I think we've had a rather better level of conversation here today. And actually, all of the conversation, I think, is marked by the level of candour and thoughtfulness of every participant that we've had. It really is so encouraging to see. No grandstanding, no defensiveness. Everybody wanting to work together to achieve better outcomes. We've had a wonderful mix of central banks, policymakers, thought leaders, investors, banks, other financial institutions, on a whole range of topics that I won't recap now for the sake of time. But hang on, bear in mind, there's more to come because we've got another day tomorrow. Let me just quickly give you the highlights on that. We'll start, if you're feeling like getting up bright and early, with a breakfast briefing on digital technology. We'll have a session on the geopolitics of climate and international cooperation. We'll have something on sustainable capital markets in the emerging markets coming up today, on GSS bond markets, on ESG data, and also finally in a cautionary but I think important session with a whistleblower on greenwashing and how to move sustainable finance forwards. If I think about what we've discussed today, I got in my head, and I don't want to paraphrase Elvis Presley, but I'm going to. I think we should keep the conversations going, but we need a little more action, please. And if that's something that we can achieve as a group and people listening in today can help to do, then we will all feel much better and feel like we're moving forward. There's so much to do. The clock is ticking, as we all know. But for now, for today, ONFIF is leaving the building, but we'll be back tomorrow, and we hope you all will be too. Thank you very much indeed.